Okay, so this chapter, I have a couple handouts that I'll hand out. They're also on Blackboard if you lose them. But I'll hand out in a couple minutes that kind of talk about the different filing statuses a little bit differently. They're not from your book. They're actually from the VITA program that they kind of go through in a little bit more detail about, and they're more of a decision tree. But a couple things we're going to talk about is how to calculate tax liability. We're also going to explain the personal and exemptions and the filing dependencies and how to determine someone's filing status. That should actually be the easiest of all of them. So this is your tax formula. So when you're trying to figure out your tax formula, I don't know if any of you guys brought your 1040, but when you're looking at your 1040, you have your for AGI deductions and you have your from AGI deductions. And I believe let's see if I have it with me. I know I handed out, there we go, handed out the first day. When you're looking at your for AGI deductions, when I put it up here on the screen, your for AGI deductions are every deduction that's going to come from your income's line 7 through line 22. So when you have deductions for AGI, they're going to be on line 23 through line 36. Those are what we call our for AGI deductions. So we have our gross income, and then we have our for AGI deductions. So line 7 through 22, or the total goes on line 22, that's our gross income. All right, that's our total amount of income coming in the door. We're going to go through and look at those line by line as we talk about the different types of income. But in there we have just our typical W-2 wages that we have if we own a job. We have our businesses, capital gains, IRAs that total to our income. But the line 23 through line 36, those are deductions that would reduce that income to a total that goes on line 37. That's called our adjusted gross income. So any deductions that occur on the front page of your 1040 are something that's called for AGI. Right? For AGI deductions, and that gives us our adjusted gross income. If you turn it over, or on the second page, excuse me, of your 1040, this is called your from AGI, or another way that they talk about it is below the line. Above the line refers to deductions that occur above AGI, and below the line are deductions that occur after AGI. So from AGI deductions are things like your exemptions and your personal deductions that we're going to talk today about, or your itemized deductions. If you don't do the standard deduction, you do the itemized deductions. Those are your after AGI deductions, or your from. We also have things that besides your itemized and your standard or and your exemptions, we also have various credits that we will talk about. Credits are much better than deductions because credits are dollar for dollar. Deductions reduce your taxable income. Credits reduce how much tax you pay. So if you owe $300 in tax and you have $500 in credits, you could possibly be getting $200 back, depending on the type of credit it is. But if you have $500 in taxable income and $300 in deductions, you still have $200 in taxable income. So it's a little bit different in how you do it. And then when you're done, you get your taxable income, which is on line 43. So your above AGI deductions or your for AGI deductions are on the front page or your first page of your 1040, and your from AGI deductions or your below line deductions are on the second page after AGI deduction. All right, after we come up with that, after we get our taxable income, we then have We then have our tax rates, which I know you worked a little bit with already on your homework. When you do your tax rate, you have several different tables that you can use, but the most common one that you're going to be using is going to be the one where you come up with your total amount of taxable income, you subtract it from a base amount, you get a dollar amount, and then you multiply the difference that's left times like a percentage. That equals your income tax liability. You add in any other type of taxes that you might owe. Those taxes could be a variety of different things that are on the 1040. They could be things like AMT tax, which is the most common. And then you have your credits. Prepayments are when you go ahead and you pay ahead of time. Why would you pay ahead of time? You might pay ahead of time because you pay quarterly payments. Right? Quarterly payments are something that people that are self-employed a lot of time will make quarterly payments. Okay, if you don't make quarterly payments and you owe, or you don't make payments at all and you owe, you could be hit with an underpayment penalty. And we've had people come into VITA and they don't understand why they have to pay a penalty. And year after year, they've owed money. And you're usually given a grace amount of money that you owe. But when you start owing up and over $1,000 year after year, they're going to look at it and they look at how much did you owe last year. Well, last year you owed $1,000. This year you owe $2,000. They're going to start penalizing you because we're pay as you go. Right? That's our tax system. Meaning, as you make the money, you're supposed to be paying taxes. You and I that have a W-2 type job, we don't get the option not to pay taxes. So you, as a contractor, do not have the option not to pay taxes. You're supposed to pay them quarterly. Another reason that you would have a prepayment is you can take your refund from this year and you can roll it over to next year. I personally don't know why you would do that. But there are people that will take, if you owe year after year and for some reason, let's say you make your quarterly payment in January, because your quarterly payments are such that you make them in April, July, October, and January. So you're making your last quarterly payment in the year of the return that you're doing. So you make that January payment and you pay too much. So you have a $300 or $400 overpayment. You can apply that towards your next payment. So you can keep doing that. Well, if you pay too much, you can make that as a prepayment. So that kind of makes sense. But I can tell you, like my grandma had her taxes done every year. I'm not sure she even looked at them. And whenever she got a refund, she applied it to the next year. The problem was, I think her tax guy stopped looking at her return because the last 3 years he did it, she got a refund and he kept applying her refund towards the next year. But no one ever relayed that. No one ever looked at her taxes. So she kept making quarterly payments and she kept getting a refund. And her quarterly payments were too much. She should have lowered her quarterly payments. So finally, when she wouldn't leave her tax guy because it was my grandpa's tax guy. And my grandpa passed away like 30 years ago, but she wouldn't leave him. So finally, once she kind of got to the point where she really wasn't making those decisions, I started doing her taxes. And I'm like, why are we rolling over $500 too? She didn't even need to make quarterly payments by the time I did her taxes. She was getting money back. So it's one of those things you really need to keep your eye on, because I do think sometimes your accountant just gets in a habit of doing things and they need to look at it once in a while.
What is the name of the form? 941?
Quarter 941, yeah, and there's a form that you fill out, right. All right, so we know we do the 1040. There's two different types of way that you look at income. One is called realized income and one is called recognized income. We realize income when we see a change in our property rights or our gross income. Something's included in our gross income, but that doesn't mean it's recognized on our tax return. Recognized income is what's reported on our tax return. So when you're looking at things, we might realize that a change in our income from a standpoint of our salary goes up. We got a raise. But when does that raise take effect? Maybe it takes effect over the year. So my salary just went up, but my salary is only going to go up over the course of the next 12 months. How much of that's going to hit my income? Right? Or you could also have bonuses. Right? Bonuses hit when you get them, not when you recognize them. So you might reach your bonus today, but when do you get your bonus? Okay, you get your bonus in, what's today? Today's September. You get your bonus December 15th. That's not a good date. You get your bonus January 15th. All right? You realized it in your mind in 2016, but you're going to recognize it in 2017. So you report it when it's recognized. You report it when you physically have the money. All right? Excluded or deferred income does not go on your tax return. Deferred means it's recognized till later. Deferred means you did not get the money. Deferred means you got your bonus, but your company can't pay you, and so they're going to owe you the money. And when are they going to pay you? We don't really know right now. All right, so they're going to defer that money till later. Probably the biggest way you've heard deferred income is like when you hear athletes sometimes, especially really high-paid athletes, you'll hear them say that they've deferred their like bonus for a couple years so that they can go out and do a signing bonus for another athlete because of salary caps. So when they defer that, that means they're not physically getting it. It is not recognized income. All right, so you do not recognize it until you get it. So deferred will be recognized at some point. Excluded income is interest, or example is like municipal bond interest, where you will not include it, or the gain on the sale of a residence. Now we're going to talk about the gain on the sale of residences because sometimes they could be included. But for the most of us who are not in the business of flipping houses and who do own our house for to meet the qualifications 3 out of the 5 years and living it for 2 of the 5, having it 3 of the 5, we do not have to recognize the gain as long as that is not something that we are flipping. So then we don't recognize the gain on the sale as well. All right, so what we look at income. There's a couple other things where tax exempt means there's no tax. Hopefully we kind of know that now, right? Tax exempt. Tax deferred means no tax in this year. Ordinary rates are from the tax schedule, which you guys have already looked at. But then there's something called qualified dividend rates. Now these get a little tricky, and this is probably the most missed thing on your practice problems, on your homework problems, and my guess is on this tax problem, but it's new, so I can't tell you for sure if it's going to be, when you're trying to get the right tax at the end, is that you do not tax your dividends at the right rate. Dividends are taxed at different rates depending on the type of dividends they are. Qualified dividends can be taxed at 0, 15, or 20% depending on the income level. Most dividends that are qualified in this class are usually going to be taxed at 0, and we might get some at 15. So you have to back those out of your total income. So when you look at your taxable income, let's say on your problem your taxable income is $60,000. If you had $3,000 of taxable dividends, and they're qualified, you don't have $60,000 of taxable income. You had $57,000 of taxable income. You have to back out $3,000 because that $3,000 is qualified dividends and the tax is 0. So you got to back that out. Capital gains and losses, it's a whole chapter on that. It depends on whether they're short or long term. If they're long term, you have a better tax rate. The government's trying to incent you to invest in long term versus short term rates. Short term rates are usually going to be exactly what you're already paying. Long term are going to get better rates. Capital assets are usually anything except for accounts receivable, inventory, and any other asset that is used in the sale of exchange of businesses like supplies. All right, I kind of already just said that. The one thing I didn't say, and again, we'll go through some of this in much more detail, but capital losses are when, and I will show you on the first page of your 1040, when you look at your business income, and it is on line 13, capital gains and losses, not business income, sorry. When you look at capital gains and losses, line 13, if you have capital gains and losses, which is usually things like the sale of stock, you have to fill out something called a Schedule D. In addition, you'll also have to fill out now something called an 8949, which flows to a Schedule D, which flows to line 13. You can put as much money as you make on that line. You can make $3,000, you can make $108,000. Whatever you make profit goes on line 13. If you lose money, you can only put a loss of up to $3,000. All right, so you have to put all you gain, but you can only put a loss up to $3,000. Now, I'll give you a couple reasons why, and then we'll talk more about it when we get to capital gains. You can continue to roll it forward, if that makes sense. So let's say I have a loss of $12,000. I can put $3,000 on this year's tax return. I can put a negative $3,000 on next year's, a negative $3,000 on the next, and a negative $3,000 on the next. So I can deduct the full 12. I just have to do it over 4 years. The reason for this is because especially wealthier individuals would be able to take huge dollar losses. But even if you think about it, even us, if we did it right, if your income was $40,000 and you had some stock and you sold the stock at a $50,000 loss, even though it really wasn't a $50,000 loss, because you got to remember, right now I own, this isn't a good example, but right now let's say I own $6,000 in AT&T stock. If I bought that stock 20 years ago at $12,000 and I sold it today technically I would lose $6,000. But am I getting $6,000 cash? I'm still getting $6,000 cash. When I sell it, I'm going to get $6,000. But when I bought it, it cost me $12,000. But I bought it 20 years ago. So investments like that, it doesn't matter when you bought them, when you lost money. When you gain money, it does. You get a different tax rate. So they limit the loss to prevent astronomical losses on the tax return. And think about 2008 to 2012 when the stock market tanked. There literally could have been millions of people that did not pay any tax at all. I mean, my 401k went in about half, right? And I didn't sell anything. I just let it go, and hopefully it's going to come back up. But there were a lot of people that sold a lot of stock because they panicked and because they wanted to get out of it as well. And there was a lot of people that sold a lot of stock so that they could get cash so they could reinvest when it was low. If they sold stock at a loss, they could have written it all off and they could have paid no taxes. Or, better yet, they could have gotten a huge refund. So that's why a lot of it's limited. So we'll go into it again more when we talk about capital gains, but you cannot deduct more than $3,000. So let's go back. I hate how I have to flip back and forth between that. All right, so deductions for AGI, I already told you above the line. We determine them in adjusted gross income, and they always reduce dollar for dollar, which is what I said. Deductions are dollar for dollar. Below the line are from AGI, same thing. Now, this is one thing you got to remember, and I think you might have seen this in a problem as well. You take the greater of the itemized deduction or the standard deduction. You do not take both. You take the greater of either one. If you take both, you're not going to get the right answer. So you take the greater of them, then you have your personal and dependency exemptions, and then it says, the question is, why might a from AGI deduction not reduce taxable income? Does anybody have an idea why you might have a from AGI deduction that would not reduce taxable income? So if I go back over here, these are all from AGI deductions, second page of the 1040. Line 39 to 42, why might one of those not reduce taxable income? What could happen?
Your income very high.
Okay.
They're going to use the alternative minimum tax. They will avoid the standard deduction.
That's good, and we haven't even talked about that yet. Yes, if your income is really high, or actually not even really high, depending on if they adjust AMT, but if you have AMT come into play, they do limit your itemized deductions. We haven't talked about that yet, but that could be one of the reasons. All right. You also could have, if your taxable income gets below zero, then your itemized deductions or standard deductions can't reduce it below zero. You cannot take your taxable income below zero. You cannot go negative. You do not get a positive tax back. All right, that doesn't work. We will talk about refundable tax credits in later on. And then the other thing is you only get the standard or itemized deduction. So one of those will not reduce it. So that's one of the reasons. All right, so let's talk about the different type of standard deductions. So this is if you are not going to itemize. This is if you're not going to itemize. What I thought was interesting is only one of these changed from last year. That's not always normal. That happens once in a while. But only one of these did not change, and it was head of household, I think. Now I can't remember. I believe it was head of household. So married filing jointly and qualifying widow, $12,600. Married filing separately is exactly half, and so is single. And then head of household. I think head of household last year was $92,050. So it went up by $50. So married filing jointly is pretty self-explanatory. You're married, you're filing your tax return, which is what in the Simpson video, he tried to cut in line, and his wife basically said, not unless you want to file jointly. All right. Qualifying widow or widower, you can only take in the years to follow after the death of your spouse if you have a child or a dependent. You cannot take that after the death of a spouse unless you have a dependent. And that's only for the 2 years, the year of the death and the year out after, that you can take that. All right. It's basically just kind of like a grace period following into what you will then take as head of household. All right. Married filing separately is when you're married, but you're not filing the same tax returns together. And I kind of alluded to that last week or the week before. That is usually not going to be a benefit to either one of you. The only case that I've seen where you want to do that is if one of the spouses owes back taxes and you're trying to keep a refund on one end while the other spouse pays the back taxes on the other. I guess there's some ethics on which way that goes, but we've had that done. We've had somebody come in and they filed separately because one spouse owed back child support and the other spouse didn't want her refund going to pay his back child support. So they filed separately. They took his refund to pay his back child support, and she got to keep her side of the refund. So that was another reason. The only other time I've seen it is when I had someone whose spouse left them, and we're going to talk about that today, but had not left them for a long enough period to be considered what's called an abandoned spouse. So she filed married filing separately because she was not with him and couldn't do married filing jointly. But it was not advantageous for her. She had to do it. All right, head of household is when you are not married and you can claim what is called either your dependent or a qualifying person that could be a dependent. That is obviously the most advantageous if you're not married. And then single, which is basically everything else. And then there are different standard deductions that you can add to that if you're a certain age and if you're blind or maybe it's just blind and old age. I can't remember. I think it's just blind and old age. Isn't that horrible? I know one of them is blind. I'm drawing a blank on that one. Blind and old age, but I think I'm missing something.
Maybe deaf?
No, it's not deaf. It's just that. And it's completely blind. Because my dad is blind in one eye, and that does not matter. You have to be considered legally blind. And we had a guy come into the VITA program, and he's sitting right in front of 2 students, and he had someone with him and his wife, and they were talking about how, you know, he gets to claim the exemption for being blind. And I mean, he's looking at me just like you're looking at me, and we're talking, and I'm like, now you realize you have to be legally blind. He goes, oh, I am. And she's like, oh, God, he is. He can't. You don't want him in a car. We got a note. He can't see you. And I'm like, oh, okay. I felt really bad, but I was just kind of like, he was looking at me like there was, but he could not see. So I'm like, okay. And I felt like I was kind of questioning him, but, you know, you have some people come in and you're like my dad, like when I first started doing taxes, I'm like, he can only see out of one eye. Does that count? No, that does not count. He has to be blind out of the other one, too. So he said that's not worth it to him. He'd like to just see out of the other eye. All right, so then we look at our tax calculation. We already talked about that we're progressive, meaning the more money you make, the more tax you pay. And then we had our preferential rates, which I've already talked about, long-term gains. If you have your investments in long-term and you sell them, you get a preferential rate. Qualified dividends are a preferential rate. And tax on these items is calculated separately, which is what makes it hard for you guys sometimes to get that right tax rate. It also makes me hard to grade your tax projects sometimes because I have to go figure out what you did if you don't have the right tax rate. So, what are some other taxes? Zaid mentioned AMT. We'll talk about that. I always hate talking about that because it's not easy. It's just as convoluted for us to talk about it as it is for people when they try to figure out if they owe it. Probably one of the best things that came about was being able to use a computer to calculate your taxes because it helps calculate AMT. The problem is if you don't answer the questions right or you skew your answer to the questions, you're going to end up paying it or not paying it when you should or should not. I mean, you could answer them the wrong way, so you got to be very careful. Self-employment taxes, obviously that's when you're employed on your own. Net investment taxes, and then additional Medicare taxes are going to be based on income. And then tax credits, I mentioned those already. Prepayments, I mentioned that. The best prepayment is the fact that when you work on a W-2, you have wages taken out of your taxes. And then estimated taxes and overpayment that I mentioned. Okay, the personal exemption for this year and dependent exemption is $4,050. Last year it was $4,000. So you can see the jumps from year to year are never gigantic. They're always very gradual. When you're looking on our tax returns this year and you're looking at the numbers and you're using the 2015 form, every time you get to line 42, it's going to say $4,000. When you're doing a problem for me or a problem where you upload the form, you're going to need to remember it's $4,050. All right, because we are always going to be using a 2015 form, unfortunately, but with the 2016 numbers. And then all the numbers, luckily for you, on the standard deductions are the same, with the exception of the head of household. So there's not much to look at there. Once we get to where we go ahead and buy the tax project, I'm going to have to double check and see what forms they're using there. I'm curious to see if they have the new forms or if we're going to be using 15 forms, which could be the case. All right, so that's the number there. And then what does it take to be a dependent? First of all, you have to be a citizen of the United States or resident of U.S., Canada, or Mexico. Right? So notice how it's citizen or resident of Canada or Mexico also counts. You cannot file joint with a spouse and be a dependent of somebody else. So I cannot be my parents' dependent if I'm filing a joint tax return with my husband. All right? You must be a qualifying child or qualifying relative. That's where sometimes things get a little confusing. It's not whether or not you're a dependent. If you have a kid and the kid lives with you, that's pretty straightforward. It's all the other qualifying child and qualifying relatives that get a little bit confusing. So there's 4 things we got to look at. You got to look at the relationship, the age, the resident, and the support. Right? The relationship, there's a window. The age is very easy. Support's pretty easy. All right, there's a dollar amount. And then the resident is, do they live with you for at least half the year? All right, with the exception of your parents. So the relationship test for a child. Now, the relationship test for a child is different than the relationship test for a family member. I just forgot the name, so we'll say family member, all right? Child can be a son or daughter, stepdaughter. It can also be a foster child. It can be a brother. It can be a sister, half-sister, stepsister, or any descendant of those. So if you notice, it's son, daughter, child, brother, sister. It doesn't go upward, all right? So it does count that you could have a brother or sister that could count, but it doesn't go up where it's aunts, uncles, or anything like that. So son, daughter, stepbrother, any of that type of thing, or foster, does count foster children. They have to be under the age of 19, or they have to be a full-time student. All right, so that qualifies all the way around. Even as my dependent, my children have to be a full-time student or under the age of 19, I lose them. Now, what qualifies as a full-time student sometimes gets people. A full-time student is a student that is enrolled for a full semester. 12 credit hours for one semester, which is technically, it's half the year, which is one semester. I kind of said that backwards. So if you go one semester to school and you're under the age of 24, you are a full-time student at 12 credit hours. All right? If you happen to go to one of the schools that is still quarters, you're messing with me. But I think it's 2 quarters then that you have to attend. There's only a few of those that are still out there, but there are still some colleges that go by the quarter based. And then it's full. So you still have to be a full-time student on them. Don't know if it's 12 credit hours, whatever they consider full-time, and then I believe it's 2 quarters that you have to be enrolled. Or permanently or totally disabled. All right, permanently and totally disabled. If you are permanently or totally disabled at any point and you live with somebody or you're in another facility and you're being fully supported, then you can always be claimed as a dependent. All right, the residency test. They have to live with you for more than half the year with the exception of college, right? If they're absent, or not just college, but temporary absences. So they can be gone. Your dependent can be gone, but they have to be what's considered temporary. They cannot just be living somewhere else, not going to school, and you be like, oh yeah, I still support them. All right, that has to be considered a temporary. Support, you have to supply more than half of their support. So scholarships do not count. And the other thing that doesn't count is if they have a job and they are putting that money away and not using it for their support, that does not count as their support. If they are not paying for their day-to-day bills and you are, or the person is, that is the support. So if their yearly support is $6,000 for room and board and food, and you're paying $4,000 of it, then you are providing more than half of their support. Even if they made $5,000 that year. Right? It's who is providing most of the support. All right, so here's an example. Rodney and Anita have 2 kids. Braxton's 12. He lives at home. Tara's 21. She's a full-time student, does not live at home. Tara earned $9,000 in a summer job, but did not provide most of her support. Are they both qualifying children? Yeah, all right. So she's going to put that in the bank, and she's going to have it when she graduates from school. That's okay. So you go through, and here's your solution. Yes, scholarships, again, don't count as support. And Braxton is too young. Now, if there's tie-breaking rules, which sometimes they are, the first goes to the parent. The second goes to who lives with who the most. And the third goes with whoever has the highest AGI. I don't quite get that one, but the third, it goes with that. I'm guessing it's the highest, it's a better tax advantage to that individual, but that's who gets it, is the higher AGI. So now I had to read this one several times before I read it right. Okay, so Braxton's uncle Sean, which is Rodney's brother, Rodney is Braxton's dad, right? Lived in their house. They said the Halls, but it's their house. The same home that Braxton lived in. He lived there for more than 12 months. Can Braxton meet the requirements to be Sean's qualifying child? So basically everybody's living in the same house is what it comes out to be. Can Braxton be Sean's, his uncle's, qualifying child, even though his dad's in the house? Now read the question. Does Braxton meet the requirements to be considered Sean's qualifying child? What's the requirement? First of all, does he meet the relationship test? Can an uncle claim a nephew? Yes. An uncle can claim a nephew. Is Braxton the right age to be claimed for a child? Yes. All right, do they live in the same residence? Yes. Does he provide most of the support? We don't know, but we do know that Braxton's 12, right? So, depending on what's going on, he could possibly meet the requirements. We just don't know, right? We just know that Braxton doesn't provide his own support. So his uncle could meet the requirements if his uncle provided the support. So an uncle can do it. Now, what would happen? Who is allowed to claim Braxton? Based on if everything's equal, who would be allowed to claim it? And he's considered to be Sean. Okay, Braxton could be considered Rodney and Anita's child, qualifying, not their child. And he's considered to be Sean's qualifying child. Under the tie-breaking rules, who gets Braxton? The parent, yeah. So even if they both paid money, even if they literally split down the middle how much they paid to raise the kid, the parents would get it. Right. Now, does that happen very often? Hopefully not.
Would
All right.
it lean more in favor of the uncle if they were living in his house?
No. Not unless uncle was paying a lot more. Yeah. And even then, it's sometimes really hard if the parents are living in the same house. All right, now this one's different. And I'm going to go ahead and hand out, this is what's online also. These are just different ways. It's not, they're the exact same rules. There are no different rules in what no different rules in what you already have. But it's just a different way of looking at it. And so the first page is rules for claiming a child, which is what we just talked about. But then on the second column, test to be a qualifying relative, which is what we're going to talk about. And then if they're more than one person, which was what we just talked about, the next page goes into dependency, which we're then going to go about. So notice on a qualifying relative, we got relationship, support, and gross income. Relatives don't have an age. So what we're talking about here is, can I claim a relative who's not a kid? What if I'm supporting my brother? If my lame little brother living in my house, not little, if my older little brother is living in my house and I'm supporting him, at what point can I claim him as a dependent? Or, what we're going to see is my parents. Can you claim your parents? Right? Which the answer, hopefully you already know, the answer to that one's yes. All right, you can claim your parents as a dependent. So the relationship test, and this one's a big one and that one's in here. The relationship test for a relative is much bigger than it is for a child. All right, the relationship test for a relative is grandchild, child, parent, grandparent, sibling of a taxpayer, brother or sister, son or daughter of a taxpayer's brother or sister, but not a cousin. All right, so son or daughter, so my nieces and nephews, but no cousins, just my nieces and nephews. Sibling of a taxpayer's mother or brother, so my aunt and uncle. An in-law, father-in-law, sister-in-law, or an unrelated person who lives in my home for the whole year, but never my cousin. I find that hilarious. So I can have you live in my house who's completely unrelated to me my entire year, but my cousin cannot live in my house and I cannot. I don't know what that is. But basically every other relative, I think, is on there except for your cousin. So don't let your cousin live with you. Okay. The support is the same. The support is always the same, more than half. Right? The gross income comes into play here. A child doesn't have the gross income in there with the exception of the student, and then it's just half, right? Here it's not half. Here it is, does the gross income that they make more than the exemption? And your exemption is $4,050. So do they make more gross income than the exemption amount, $4,050? So we have to figure that out. So John is 22. He lives in the dorm most of the year, but he spends most of the rest of the year living with his parents. He has a $5,000 scholarship, works hard to support himself. He earns $6,000 of his own expenses. His parents have supported him by paying $7,000 for food. Are John's parents able to claim him as a dependent? So, what do we need to look at? First of all, does he meet the age?
Yes.
Yes. Does he meet the residency? Yes. What about the support? Yes. Because his parents supported him by paying $7,000 for his expenses. He also said he paid $6,000, but they paid $7,000, right? The scholarship does not matter. So we have everything. The gross income does not come into play because he is a child, not a relative. All right, so let's, I want to ask you, okay, I got to find it. Let me ask you this question. This is actually more of an ethical question, but I want to see how you guys answer it. I had it marked, but of course I lost my page. There it is. Okay, so Blake is 21, all right, at the end of the year. During the year, Blake was a full-time student. He worked part-time and earned $8,000, which he used to pay all of his $6,000 living expenses. So he earned $8,000 and he paid $6,000 all of his living expenses. Blake's parents, Troy and Camille, claimed Blake as a dependent on their joint tax return. After filing the tax return, they told Blake that they owed him $3,001 for his annual living expenses. What do you think of the strategy to claim him as an exemption? So he made $8,000 and his living expenses were $6,000. His parents claimed him as a dependent, and then after they got the tax return back, they gave him half of his living expenses. So what do we think about that? So has he made too much income? Should he be able to be claimed as a dependent?
No.
He shouldn't be. So, but what about if his parents paid him back?
We're paying him back in the next year.
They're paying him back in the next year. So, since it was done after the fact, what would what would happen to the next year? If they gave him $3,001 the next year, how would that be classified on that tax return?
If everything stayed the same, then they could file him as a dependent.
Except they did it wrong the year before. So what kind of mess are they getting into? And how would that get caught? They're not Homer Simpson. They're not diving through the door, right? And throwing their tax return in a pile that goes into either, what does it say? Easy tax return, give them their money back, or severe audit, right? So how do you think that works? So if you claim your kid as a dependent, you say they're in college, and you say you're taking care of them, but yet they're actually paying their own expenses, you get a refund and you give them money, how do they know that? How would the IRS know that you did that?
Maybe because he has a W-2, they can't figure out.
Yeah, but remember, just because he has a job doesn't mean he has to pay for his living expenses. He can take that money and put it in the bank. You could make $5,000, and if your parents paid for your living and you put that in the bank, then they can still claim you.
He would have to not claim himself as a dependent then.
He would not be able to claim himself. That's true. As long as he
would
didn't,
have to know that they were doing that before he filed
Yes,
his
yeah.
taxes, or else.
which I can tell you happens all the time. In VITA, we sit there and you will sit in front of me and I'll say, did your parents claim you? No. Are you sure they didn't claim you? No, I'm positive they didn't claim you. Okay, because you realize if they claimed you and I click that you claimed yourself, it's going to kick back. And the difference in your refund's like $2,000. So right now you're getting $2,200 and you're going to get like $200. No, they didn't claim me. Okay, I run it the next day, I come in, your parents claimed you. So then I have to call you and say, your parents claimed you, I'm going to refile and I'll send you your taxes, you're getting $200 back. Oh, okay. I mean, at least 4 or 5 times a year. And we sit right, did your parents, no. Are you sure? No. All it takes is like, hey, Mom, are you claiming me? No. But no, they're not. And I tell them every time, it's not going to go through because what happens is the Social Security's match up now. Is a paper filing, you got away with that stuff a lot more. The only way it would work is if you filed before your parents. All right, if he files before his parents and his parents is going to bounce back, your parents aren't going to be very happy because your parents are almost always going to benefit more from claiming you than you are claiming yourself as a college student. Because the other thing is if you're going to school and you're trying to get the education credits, which we'll talk about later, you can't take the education credit. Your parents can. You can't take that under age. So if you take yourself, you're losing out on anywhere from the American Opportunity is $2,500. So your parents just lost $2,500. And that's not a good thing. Even if you're paying for your college and they're paying your living expenses, you just lost out on $2,500 if they were going to pay you back. So it doesn't work usually. You need to make sure who's paying for who. And there's cases where students are paying for themselves and they should be their own dependent. But it just cracks me up when you're like, are you really sure? No, I'm sure. So when you're going through and in this case, it was done after the fact and Blake provided his own living expenses, it is a tricky one because there's probably a good chance they wouldn't get caught. And they are going after the fact. So what do you think would happen if they were audited? What would they say? What could they do? How would they get out of it? And then do you think they're really going to give Blake the money, or was that just their ploy to say we're taking you as a dependent in case they were audited? Did they actually give him the money? If you were an IRS agent and you audited them and you found out, well, he paid his own living expenses, and they said, well, yeah, but after we got it, we reimbursed him. Would you ask for money trail? Okay, so you see a money trail, and then what would you, you explained to them, okay, you can't do that, you got to pay for it up front, in which then maybe you'd flag to do them again, or if they did pay for it, they are paying for their living expenses, but you mentioned they're doing it in the next year. So it's just something to think about, because when you're doing someone's taxes, that is something you will get hit with a lot. So then what do you do? What do you do as an accountant, as a CPA, if you know the parents aren't paying for it?
Then you can't.
It's hard. It's hard because part of the job is that you have to do what you believe, but at the same time, you also can do what you believe if you believe they are telling you. If you have reasonableness to believe what they are telling you is true, then that's okay. However, once you sign a return, you are also standing behind them and doing it. The VITA program is a little bit different, okay? We can go with what they say, and we don't have any legal liability behind them because students are doing the taxes. But that's a little bit different than normal. So once you get to the part where you are signing returns, you got to be very careful. And if you're ever uncomfortable about doing someone's taxes, don't do them. And remember I told you about my husband's friend? Okay, this is funny. He ran into him last week at a fantasy football draft. And the only reason I know is because my son goes, that guy was so funny. And my son, he's either going to rule the NBA or NFL as a commissioner someday, my 14-year-old, or he's going to be a degenerate gambler. I'm not sure which one he's going to do. But he's got a mathematical mind that just frustrates me because it's so good. And so he goes to the fantasy football drafts. He's been going for years with my husband, and he usually wins. So he went with him. He came home. He kept talking about this guy and how funny he was, but that he was weird. And going on and on, I'm like, who's he talking about? And I'm like, Greg. I'm like, and he's like, and he said his last name. I'm like, are you kidding me? I said, oh, I just completely used him as an example in class today. I said, you haven't seen him like in 10 years. He goes, nope, but he was there exactly the same. I'm like, I don't want to know anymore. And I just stopped. So just left it at that one. I'm like, let's not talk about it anymore. He's like, okay. So my son's like, what? He's a nosy busybody too. I'm like, nope, nothing. Just go back to your draft. So, but I just thought it was funny because I mentioned it, and then I'm like, really? So, all right. So here's our filing statuses. We did talk about them. Let's a couple we talked in detail, but let's married filing jointly is the one exception is what I just said about the surviving spouse, which we'll talk about. The one thing here with jointly is when you file jointly, you're both liable for the other person's tax liability. So it is something, that's why some people just won't file jointly. They don't want to because then you're responsible. As soon as you sign that together, if your tax liability comes up to be, $4,500, but it's because your husband decided not to pay taxes out of his income, guess what? You're liable too. The only thing that doesn't transfer between spouses is your student loan debt. That's like one of the only thing that doesn't transfer. Your student loan debt dies when you die. Or if you get divorced, it goes with you. It's one of the only things that doesn't get cut in half in a divorce or doesn't transfer upon death.
Don't have to pay for it.
Your kids do not get it either. Something happens to you, your student loan debt goes away. It's one of the few, and it's kind of like medical too. However, if you're married with medical debt, it goes to your spouse. But if you're single with medical debt, it goes away. All right, so we did that. Married filing separately. Again, you're married, you file separate returns. It's not beneficial. However, there might be reasons from a non-tax expenditure. Qualifying widow, like I said, you get it for the first 2 years, and it's the first year is the year in which your spouse dies. So sometimes that's a little deceiving. People think they get it for 2 years. It's the year your spouse dies and the next year, and it's only if you don't get remarried. If you get remarried within those 2 years, and I know that seems like we are sitting here right now going, well, why people do get remarried in that time frame. If you get remarried, then it goes away. And you do have to have a child. Not a qualifying relative, but an actual child to claim that. If you don't have a child, then after you can claim married jointly in the year of death, and then the next year you're single is where you go to. Single is pretty much single. And then head of household. All right, so head of household is unmarried or considered unmarried, and that's when we're going to talk about what abandoned spouse in a second. Not a qualifying widow, but you pay more than half the cost of keeping up a house. And the person that you're paying for the house has lived in your house for at least half the year with the exception of your parents. And what do I mean by that? Well, qualifying person for you to claim this is what we already talked about. However, a parent is the only person that does not have to live with you. The only person that does not have to live with you. And your cost of that you spend, like, with a kid, it's their tuition and it's everything. The cost that you spend on your parent can be maintaining their house, or it can be maintaining their food, or whatever half of it is. It's the only one. And I'm not really sure how it started with that one, but it can be the assisted living part too. If you're maintaining assisted living, if you're paying costs for nursing homes or anything like that, that could be part of your dependency. But one of the things you got to be very careful about is if you take on a parent as a dependent, you also can take on their debt. So you got to make sure you weigh some of those balances. And I only say that because medical bills that are not paid can transfer upon death to the family. So if you take on a parent for, like, one of the reasons people take them on as a dependent is for health care. If you have health care, your parent doesn't have health care, you take them on as a dependent because you're helping to support them anyways, they then can get your health care. They have their health care, you're getting to claim it as a dependent, which is a big tax deduction. Everybody's happy. But then over time, if their medical bills rack up and they're not being paid, they can become yours. And that's something you need to think about, right? Qualifying relative who's not a parent does need to live in the house for more than half the year. They do need to qualify as a tax dependent, and they must be a relationship through what they call family relationship. All right? If only related because they live with you, they have to live with you for the entire year. So outside of your cousin, who can never be that person, a friend would have to live with you for the entire year to be a qualified person for head of household. Let's see. All right, so abandoned spouse. I've had one person who I've had to do this for. Their spouse refused to file a tax return. They were married. They had not gotten a divorce. She wanted a divorce. He would not give her a divorce. He had not filed a tax return in 2 years, and we were going on the 3rd year, and she did not like it. She was very uncomfortable with it, which obviously most people hopefully would be, and she did want to get a divorce, and she's a very quiet person, and so she didn't know what to do. So her friend of hers referred her to me, and so what we did is we filed the 2 years that they hadn't done it. The 1st year he lived with them, but they just didn't do their taxes. So we filed married filing jointly, just normal every day, but we couldn't do, married filing separately, but we couldn't do jointly because he wasn't going to sign it. So we just did it like everything, and she just took a hit. It wasn't pretty. She owed money because she had to take, I said, if he filed, would he itemize? And she said yes. So that means she had to take 0. And we'll talk about that later, but that was a big hit she took. The next year, he had moved out that year. The next year, she was able to take abandoned spouse. Because if they don't live together for at least 6 months, she can claim that he abandoned her. And now, she doesn't have to do married. She actually was able to claim head of household because they had a child. And she did head of household, and she was able to not have to claim itemized deduction. She took standard deduction. She actually got a refund. And then that year that we did the current year, she also claimed head of household, and then she came the next year and she was actually divorced. So she did the right thing. She got herself caught up. I actually asked her, I said, did your husband finally file taxes? And he did in year 4, but she didn't know of what years he got caught up.
So how does that work I know that if you're married filing separately, you have to both do the deductions the same way.
Right.
Either both take standard or both take itemized. But wouldn't it go off of whoever filed first? So if she files first and takes standard, isn't you have to take standard?
Well, here's the thing. We didn't know what he would do. And if he did itemize, she would have to itemize.
Even if she filed first?
Even if she filed first. So we went ahead, and it just eliminated problems by doing it. It hurt her. I gave her the options. I said, we could do this and file standard. You're going to benefit from it by doing that. But if he files itemized and he claims a whole bunch of this, they're going to come back. You're going to be audited because you're going to kick back. And it could look at both yours. They could say, well, you filed first. He has to change. Or they could kick back and say, why are the two of you doing this? You both have to change. Or they could audit both of you. And she didn't want to mess with anything. She goes, do whatever is not going to, and the least likely thing was to claim 0. And that's what she did. Actually, it wasn't completely 0, but it was basically next to 0, because she got to take her taxes and stuff like that. But that was about all she had on there. And so she got that out of the way. But you're right. You would think that most of the time it's whoever does first, but that's not a hard, fast rule. It's not just because, it's kind of like whoever claims the child first gets the child, like in a parent fighting over it. That's not necessarily true either. It's usually who gets it first has the leg to stand on. So like what I'm talking about there is in married people who are divorced, you sometimes have an alternating agreement where you get to claim the child 1 year, I get to claim the child the next. I have a friend, I'm not kidding you, his ex-wife took that kid every year. Now the kid's 25, so this was a long time ago. Every year. She must have filed on February 1st every single year and took that kid. And by the time I got him filed, which was usually like the second week of February, she had already filed and taken the kid. So every other year, he had a paper file with a copy of their divorce decree saying he got to claim the kid every other year. And then he got his refund. I honestly can't tell you if they went back to her and made her pay it back or they both got the kid, because neither one of us talked to her. So I don't know what happened on her end. But she did it every year. So in my mind, she must have got a benefit out of it, or why would she continue to do it? So my guess is that she got away with it at least some of the time, or she wouldn't have kept doing it. She did it until he turned 18.
How did you know she kept doing it?
Because his kicked back. Every other year, when he should have been able to claim it, we got a reject saying that Social Security's been claimed already. And he'd be like, are you kidding me? I mean, and it was the same letter. I mean, I had a letter down every time. Here's a copy of their divorce decree. He gets to claim in odd years or whatever it was. Here's his return. He should get, but I don't know what they did. The only reason I don't think they did anything is because she kept doing it. But she really wasn't that smart either. So maybe she just didn't know any better and she just kept doing it. I don't know.
The refunds she did.
Yeah, exactly. And she got earned income credit. We're going to talk about that. That is huge. But she didn't need the kid to do that either, so I'm not sure. She might not realize that. All right, so, okay, now assume that Rodney passed away last year, and during the year Anita did not remarry, but maintained a household for Braxton and Tara, her kids. What would her status be?
Qualified with
Qualified widow. All right, now, let's change that. Now they got divorced. Different example, Rodney and Anita got divorced. During the year, Braxton lived with Anita. Anita paid all the costs for Braxton herself. Under these circumstances, what would Anita's filing status be? Had a household. All right, bigger one. We got money now, okay? Sean, Rodney's brother, lived with the Halls, but Sean paid more than half the cost of maintaining a separate place that is a residence for his mom, Sharon, whose gross income was $1,500. Because Sean provided more than half of Sharon's support, and because Sharon's gross income was only $1,500, she qualifies as Sean's dependent. In these circumstances, what is Sean's filing status? At a household, right. So it didn't matter that Sean lived with somebody else, because that's thrown in there to kind of mess with you. And it didn't matter that his mom lived somewhere else. He still paid more than half the cost. The only thing that would matter is if living with the Halls and they claimed Sean. If Sean is being claimed as a dependent of somebody else, he cannot claim somebody as a dependent. So for example, if I claim my mom, if my mom claims me as a dependent, I can't claim my kids. All right, so you can't go down the ladder and everybody kind of benefit from it. And so it does get, if you look through some of those charts I gave you, if you look, you can actually lose a dependent. If my mom claims me, but doesn't, and if my mom provides more than half my support, but I provide the support for my kid, that means my mom can't claim my kid, but my mom claims me, nobody gets the kid. So there are examples where you don't really do things right. The best example would be that my mom support everybody, and I just get away with nothing. But so there are examples, but people do that one wrong. They do that one wrong. Because I can't claim my kid, that one will bounce back, but the mom will claim the kid, even though she didn't provide half the support. Okay, so let's look at a few examples, kind of see what we can get with this. So let's turn to our book. It's page Page 435, it's problem number 32.